Well, the S&P is now 8 days in a row straight up, and a lot of people are trying to wrap their head around this. We went through this on Saturday, so I'll link that at the end as to why the bounce. And now we're going to talk about how long this can go on for. There's a couple key things to look at. So I'm going to jump right into it. This is the New York Composite up here, and below is the Zweig breadth thrust. Now, you're going to start hearing a lot about this tomorrow, I think, because a lot of people aren't going to even be aware that it did this. But if you come over here, you're going to see you have 10 bars. You have 14 days, but you have 10 bars. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars as of. The way the technical thing for this to trigger is below 40 and over 62. Here's the technical definition. Now, technically, and this is from Sediment Trader, but you can look this up online. Breadth thrust indicator is a technical indicator used to identify momentum, compounded by calculating the advances versus divided by the total issues, advances plus declines on it. You come up with a 10-day exponential moving average. When you go from 40% to 61.5% within any 10-day period. Now, the way that I will look at this is the fact that you are talking about 10 trading days. Who cares about what happens over the weekend? Now, they might say it has to happen in 10 days. I don't believe that's the case. I believe the technical definition is 10 trading days. So I'm curious to see if they actually confirm that this one actually closed, because you really only get like 17 or 18 of these since World War II, but I think you're looking at one right here, and they usually mark bottoms. We've had one of these before, and it fired right here. Now, this is just another indicator that I have where it actually makes it green or red. And this is where it fired last time on January 23rd. Now, it doesn't mean that you're going straight up. I want to be really clear about that. But it is extremely rare to see these. And when you start going through them, it doesn't mean that you can't go back down or you can't retest. But there are areas of these that when you look at them, it's extremely rare to see these. So when we see them, we want to pay attention to them. What I'm seeing is I'm seeing a market that got completely flim-flam, that thought that we had all these issues. And then it turns out we don't have any of them whatsoever. And then on top of that, the Fed is being extremely accommodating. Now, this came out today at 10:30. In anticipation of the Fed Reserve Chairman Powell's speech at the Jackson Hole Economic Symposium, Evercore analysts have indicated Powell will be flexible on approach to rate cuts. Now, I always find this fascinating because doesn't this stuff always leak right before he speaks? So what they do is they drip this stuff out, they see how the market reacts to it, and then they make a decision whether or not they're going to say those things. Guess what? The market responded very favorably to this, that he's open to 50 basis points and that the bar is not very high. Evercore drips it out. Market goes higher based upon that. So now all of a sudden the Fed is being very accommodating to the market. So if you are to ask me in regards to the New York Stock Exchange, yes, that triggered. It also triggered on XLK, which I did go over on Saturday, and you can see the follow through on that today. The question that everyone's asking is, well, how far can this go? I mean, how much more can we go? We're already up 7, 8, 9 days in a row. I think you have to look at some of the indicators, and we're going to do that. For example, I always look at RSI for a magnitude, and I don't even have a buy signal on RSI, a technical buy signal, till about here. And then even then, you don't have institutional ownership until you started flipping up here, because you need to flip the 55 to really have that institutional ownership for them to really step in. So what are you on, day 2, day 3 of institutional sponsorship in tech? And then when you look at this, you're seeing that this RSI is sitting right down here, which I use. If we were overbought and we had this double, negative here, and we didn't just get washed out and everybody just didn't get flim-flammed, and everybody that got flim-flammed, including the CTAs, if you go look at that type of data, they all have to get back in, and they're at record levels. And so are ETFs at record levels. You guys may have already seen that, but let me show you this. Now, in front of us is levered ETF weekly rebalance. 34 billion last week, the highest on record. You can see down here, and I pointed this out on Saturday as well, people got whipsawed. And the people that are telling you they didn't get whipsawed are pretty much the only people left on the universe, because everybody got whipsawed. So don't think you're special because you got whipsawed. Just understand what's going on and figure out how you're going to benefit from it. What we're seeing up here is a clear indication that you have record levered ETFs, SOXL, TQQ. They have to put all this money to work. It's not a question of if they want to, if the market's too high. So in other words, what you have is huge non-discretionary buying. And that huge non-discretionary buying also fuels other non-discretionary buying through CTAs, which you can look up what that is. And then, of course, you have the corporate buybacks that are no longer in that window. All this doesn't care about the discretion of the market and whether the market's too high or too low. They just have to buy. So the question of how long can this go on for, it can go on for as long as it goes on for. What I tend to do is just use the things that work for me. I don't sit there and say things like this. And I know people are going to do that and go, well, we're up 8 days in a row. This was my 9 count on the S&P that I was counting for that Zweig breath thrust, and we were at day 9. Now, what's interesting about this too is at day 9, we were at the same exact level in the RSI, and we flipped here. And then we started pushing higher. And then we heard the same thing over and over again. Well, it's too high now. Can't possibly go any higher. And then that was 446. And from that point, you're up about 20%. So if I could give any advice to people after doing this for 25 years, stop telling the market what it's going to do. The most successful traders don't do that. They just trade what actually happens and they make the best of it. Whether they got stopped out, they come back the next day, and they fight. That's what you need to do. I'm just going to be candid with you. This idea that you're going to look at this and then everything's going to be rosy, and it's not. What you're doing is you're looking at past performance to glean what could happen to future performance, and you're hoping that that puts you in the right spot. And if it doesn't, that's why you have money management principles to trade around it. That's how you should look at everything, right? So when you see something like this and you're saying to yourself, the market's overbought, you're just not being honest. You just missed it and you haven't gotten in yet. And I think if you look at this versus overbought up here, sure, you could make the argument. It still went higher. Overbought here, sure, it still went higher. So you have to trade what happens and you can have your beliefs. And that's going to lead us to the next thing. But I want to show you what they're doing with percentages over the market. But when we start to take this apart, to me, this is day 1 of an inverse head and shoulders. And the idea of where we're at, let's get rid of the pre and post for a second. I understand that on the 4-hour, we're right back to where we were on July 11th when we had the negative CPI. But you have way more money that came in the market. And I want to be really clear about that. You have way more money that's now in levered ETFs than you ever had up here. You have more corporate buybacks than you've ever had coming into the market right now. And you have institutions that are completely out of position because they got flim-flam. So the idea that you can't get back to this after all of this and with more money in the market now than there's ever been, it's kind of delusional to think that it can't happen. What you're going to need is you're going to need an event. Itchy screws up the Jackson Hole speech. NVIDIA misses numbers. That kind of thing. You're going to need an event to knock us down. All of a sudden, the consumer is much weaker than we thought, even though of last week's data. You're going to need something. That said, this is a 4-hour chart, so this can stay up here for a while, and you're not even over yet. As a matter of fact, last time we were here was July 2nd to July 11th, and you haven't even flipped yet. And on average, when you're flipping here, if you note, and I always look at this, you're staying up a minimum of a week. This was 2 weeks before you came back down. Left shoulder, head, right shoulder, flips over. Day 1. This is day 1. Watch the gap fill. Doesn't mean you can't come back down, retest, maybe form some kind of weird cup and handle, and then push. I don't know what's going to get us down now. What's going to be the driving force? We have a ceasefire that they're talking about. So I would like to see the comments. You could put your fundamental comments in there about how, quote, the market's overvalued, and let me know how that goes for you. But I'd be more interested in what is going to be the catalyst. I mean, this is what the comment I'm really looking for. What's the catalyst that's going to get us down? Is Powell going to screw the speech up? Is the ceasefire going to end? What's really going to get us to rotate back down? I'm curious because I'm running out of things, because it's no longer a Fed that's not going to act. It's a Fed that's going to act. It's no longer war because on both fronts they look to be calming down. It's not PPI, CPI, or retail sales because they came in perfectly for this Goldilocks situation. You can go watch Saturday's video. So then I look at the cues and go, okay, well, this is day 2 over this level. Well, I don't have any volume. Well, of course you don't have any volume. Why would you have any volume? You're going in the Jackson Hole, right? So this is going to take time. This is one of the slowest weeks out there. But you have all this systematic buying that must go on while this is happening. Everybody knows this is the slowest time of the year. Or you're not supposed to trade because the volume's light. I mean, that's just probably the silliest thing I've ever heard. You can make an argument that you're not popping, but here was your bottom. That was the head, left shoulder, head, right, okay? When you mark this off and you look at the breadth of the market and how this is playing out, you have to trade what's happening. If you take a look at the stocks today, you can see that you're not even over the 55. If I overlay this with the RSI, you're not even overbought. Does that mean you're going to go straight up? No. Does that mean you can come back and backfill? Yeah, it does. But if you were up here again and you were rolling, I would see that we have something to be concerned about. But on the hourly, we cracked up here and we've been riding the line ever since. If we go here and take a look at the daily again, you can see when we flipped that anchored VWAP, and I would suggest that you mark these anchored VWAPs, this is what we're dealing with. So once again, we're not dealing with something that we really need to concern ourselves with. We're not really looking at something and saying, okay, this is going to be an issue. I'm struggling here to figure out what's going to get us down, and that's why I'm asking the question. Now, after hours, PANW came out with earnings. We're going to go through a couple names here real quick. But PANW came out with earnings, and they were decent. They weren't great, but they were decent. Now, if I look at this, get rid of the RSI, and I drill and pull this over, you have a shelf right here. And that volume shelf is flipping after hours, and you're pushing into it. And that kind of gives us a clear shot right back to here. If you look at the volume right here and you look at that shelf that's over here, there's no volume in here. So this has a clear shot up. Now, I'm not on the conference call. There were ups and downs on the conference call. What I always do at these after hours is I mark off key levels and I put in key factors. So for me, I'll show you what they are. And if you've been watching these for a while, you already probably have an understanding of what they are. But I take this bar and I put an anchored VWAP. And then I pay attention to how we act at that anchored VWAP. Breaks down, tries to rally, breaks down, falters, that was it, that was the end of it, tries to get over, and now you're just riding the lightning. That mark is the previous close, flips, breaks down, over, retest, goes. So is it a great quarter? You're still up, you're still positive. So that's a good sign. So we have something going on here finally in software. So maybe we can get that driving force out there and get more participation out there. And we're going to talk about percentage of stocks over their moving averages in a second here. But there's some other developments as well that I think are really important. Goldman came out, and this was a big trade for us in the room today. Early on, we did this. But we've been doing it for a couple of days, quite frankly. But today it was very clear that the Goldman comment on being ahead of this before earnings is starting to stick. And there's a firm that came out and had a position, and they 10x their position ahead of this earnings call. So you're seeing that drive the market. As a matter of fact, it's not rocket science to see when Goldman came out and put that stuff on the tape. It's right in here. And then from there, the stock just absolutely revved. So now you have hedge funds buying ahead of the quarter, not 100,000 shares. I think they moved their position from 1 million shares to 13 million shares. So it's not a small bag. And then on top of that, Goldman's doing their channel checks and saying this thing's going to crush. And they map it all out. It's on the tape. You can go look at it on Bazinga. I'm not going to, or whatever service you use, but I say Bazinga because that's what the majority of retail that watch this use. So what does this tell us? Well, when we look at this, is this overbought? Okay, so all we've done so far is come back up. We haven't had any earnings since here. And so now you're up about $10, $15 since last earnings going into the quarter. And you look at your close here and you realize that you only have 5 or 6 other closes that are up here. So where does this put us? Well, that puts us here, and then that would put us here for major supports before earnings. So then you overlook something like the RSI. And you can use any indicator that you want. I don't care if you use the RSI. I don't care if you use a MACD. Whatever you want to use to tell me that we're overbought. Do we look like we're overbought? It looks like we're just getting started. I don't even have the moving average crossing over the 50 yet. So we can say we're overbought. We can say we moved too fast too soon. Could you pull back? Sure. I'll ask it again. What's the catalyst that's going to get us down? Because things are opening up. They're not pulling back. When I bought this, I remember hearing a lot of, why would you buy high yield? Because if it's a recession, things are going to be bad. And the people that ask that don't really understand how the bond market works. When rates come in and they cut rates, high yield on average, unless they're going to default on those debt, they go higher because you're getting high yield, hence the name. So you're getting more yield than you're getting on a treasury. If we look at this, the demand for, I'll say it again, high yield is at all-time highs. That's not the signs of a recession. That's the sign of people chasing yield and growth in an environment that they want to buy. And that's very different than what you had here a couple of weeks ago. And this is what I'm seeing a lot of people in a lot of the comments. You got to swivel. You have to realize that what you thought here has changed drastically in days. And it's probably the fastest drop ever. And I want to be really clear about this. And I'm trying to get through a lot of this. But I really want you to focus on that thrust and betting against that and betting against the same setup we had in November, even though the comments will be it's not like November. I want you to go and take a look at the last time you went from 65 to 14 and how long it took. Okay, this is really important because someone was doing a study on this. We've never had this. I can't find anything like this that exists. When I go here and we take a look at the pandemic, or we go back here and take a look, we've never had a scenario where you've gone up that fast. And obviously not up here, but we've never had a scenario ever. And you can see it just by what I'm doing right here. If I drop this to a weekly, it gets a lot clearer. You've never had a scenario where you've popped up here and you've come down that fast. It does not exist since the day I've been trading. That's how many people were caught off guard. So I'm stressing this again so that when you're looking at the market and the thesis that clearly things are bad and clearly we're going to, melt down and just you wait and all that, this is very obvious that people were dead wrong. And that's how fast they got out of their short positions and how fast they covered all those other positions. It's never happened. So understand that when you're looking at this market. I try to make these videos interactive. And what I'm asking for are comments on this stuff so I know where to go with it. And I know it's not interactive. But the reason I'm bringing this up is the idea of what you thought was going to happen here is not. It's very different than a pandemic. It's very different than the great financial crisis. Everybody was wrong. It flipped, and now you have record ETF inflows. This is one of the things that has me concerned, and I'll show it to you. And I'm not going to have time to edit this, but what I do is I go and take a look, and I do this often. I will look at the stocks in the S&P watch list, and I will go look at where they are over their moving average, because I find great value in this. So in other words, if this is stocks above their 50-day, if I am below, and you might want to remember some of this, but if I'm below the 50, then I know that I have an issue. So if you go look at the market, and every time that you're below the 50, and then go look at your trades, probably was a bad time to be buying stocks on average. If 50% are below the 50-day moving average, institutions look at this all the time. They want to know exactly where they are. And you'll note this, you'll see like, oh, that's interesting. Then we popped over, then we popped back down. Yep. But this has got me kind of twisted. So here we are, the 5-day moving average, and now I'm at 90. This is kind of high. Usually there's a pullback when you're up here. Now I said that this morning at the pre-market. I said, usually when we're up here, you see some kind of pullback. Did we say it? No. I think there's only so many names left that can keep going over the 5-day moving average. But if you were to mark off these dates like April 23rd, or you mark off like May 6th, those kinds of areas, you'll see stuff where you'll be like, oh, okay, here's like July 12th. If you mark these areas off, you'll see pullbacks. And I'm just pointing it out because just be aware of it. It does exist. December 13th would probably be a really good one for us to look at and take a look at this. So if you went to this and said, okay, well, here, show me December 13th, and you go and take a look at it, you're like, well, that didn't really even go down. But we kind of sold off the next day for a couple days, and we got a little weak, and then we came back down, backfilled, and then we went higher. That's what I'm talking about. I'm not talking about melting down because of the 5-day, but you would think there'd be some kind of reprieve. We're just not seeing it. And so instead of me saying to the market, you're up 8 days in a row, you can't possibly do that anymore. Well, the VIX has never dropped that fast from being at 65 in the history of the VIX. And I just showed you that, and you guys are welcome to go through that again. So is it possible that the equity markets do something that would be abnormal as well? And the answer is yes. Again, in the comments, I'd love to hear what is the thing that's going to knock us down right now. I'm curious what people think it is. Now, I do want to cover something because I was asked about this, and I think it's really important for people to get this concept. So ASPN tonight had issued a revolving credit, and they're going to pay back a convertible bond. And then I'm going to tell you how you should be using some of this data. But Aspen Aerogels, a technology leader in sustainable solutions, today closed a loan of $125 million. And $100 million capacity asset revolving line of credit. So they have a line of credit and they have a term loan, $225. Okay, so they borrowed debt. All right, now what did they do with that? With MidCap Financial, a leading commerce financial company by Apollo. All right, focused on mid-market transactions. Collateral structuring agreement includes assets of the wholly owned subsidiary Asset Gels, including company's plans, blah, 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 blah. The proceeds from this transaction will be utilized for full cash redemption of the company's legacy. Legacy is long outstanding convertible note. For general purposes, the term loan as a maturity. Okay, why is the stock going up on this? It's this part, and a lot of people aren't going to understand this. So I'm going to give a real quick lesson on convertible note. And what this is going to do is explain why the stock's probably been going up for the past 3 days. Because they probably got a phone call here where these bondholders started to find out that they were going to get rid of the note. So what happens with a convertible note is this, and they do this with MicroStrategies all the time as well, but I'm going to drop this down and just explain this very, very quickly. Here's a convertible note, and let's say that this convertible note in here pays you 5%, and it gives you the right to buy stock at 20. And I don't know the exact terms, but let's just say it gives you the right to buy stock at $20. Because the purpose of convertibles is that they are what? They are convertible, okay? So what that does is it gives you the right to buy stock at a specific time, and it also gives you a coupon during that time. Once the stock goes up, the majority of these funds short against the convertible bond. So let's say that the stock just happens to be at 32. Well, then what you're doing is you're getting your 5%, and then you're taking a portion of all or none, and you're shorting there at $32. You're locking in $12 in gain. You've locked in the gain, and you could trade around it, but in general, you've locked in $12, and you're getting 5% while you did it. This is exactly what Buffett did with Goldman Sachs during the Great Financial. They gave him a huge coupon, and then the stock traded up, he shorted it against the bonds and just locked in a huge profit. So windfall was billions. Anyway, so and you can go look that trade up. It's online. They talk about it. But anyway, so if you look at this, when this news comes out, what happens is the people that are short, they have to go, oh crap, I'm going to have to cover this. They're going to redeem me. And then I'm net short what? the bond. So they have to unwind this trade. That's why it's trading up. Now, the question with this in particular is how many people are already out of this? How many people knew this was coming? That I don't know. So I do see us bidding up a little bit here, but this is definitely a name that you're going to want to watch tomorrow, because let's say that a lot of people did not cover, then it's going to go up a lot. Let's say a lot of people already knew this, it might actually then drop. But people still are going to have to get out of that short. And the company's now in better financial shape because it got rid of the convertible. And the short interest is going to drop, which means net long is going to be easier. And that just makes sense to people, I'm sure. But this is what is happening, and this is why it's important. I was asked about this in the community, and I figured I'd take this time to explain it to everybody. I could do a whole video on this if you guys find it interesting. But let's go through a couple things. I'm going to do a part called key takeaways. So the key takeaways of this video are this. We don't tell the market what it's going to do, right? Because we're never right. All we do is just build money management principles around what is happening, and then we make money off of it, right? This is why we have the stool. Okay. And the stool changed drastically this week, didn't it? It went from like this rickety stool to like Game of Thrones kind of stool, right? If Game of Thrones had a stool. But now you're at all-time highs. Do you really want to tell the New York Stock Exchange that it's wrong? Okay. Probably not the thing to do. I feel you fired that thrust. I think that breath thrust fired it. So we're really curious to see what some of these firms like Ned Davis and Market Sentiment say about it. Sentiment Traders, a bunch of them that are going to come out tomorrow, and they're going to have some kind of comment on it. I'm surprised they don't already, but I think it might get picked up. So you're going to want to watch that. That's the first thing you should take away. Second thing you should take away is when we looked at all-time ETF levered flows, what should you take away from that? Maybe go look at the largest levered ETF flows that are out there and see how they're acting and how they've been acting. And maybe go take a look at TQQ, which is number one. We've been trading this for days now, SOXL, and look at the performance of these. Okay, they've been nonstop, all because of inflows. It has nothing more to do within the inflows, and that is system buying. That is not discretionary. It's not up to them. As long as the money comes in, they have to buy.